As we start to consider the regulation, which dictates the way in which information is presented in general purpose financial reports, it's probably appropriate that we start off by focusing on how performance is reported. We focus on performance because that tends to be what most people focus on in the first instance. It might be investors who are concerned with firm performance, and that might dictate their decisions to buy or sell shares. It might be competitors who are interested in the strategies which are being employed by firms they compete against and trying to evaluate whether they are successful or not. It might also be suppliers who are concerned with how firms across the supply chain are generating profits and whether their profits seem commensurate with their contribution. It's fair to say that irrespective of the use that you have of financial reports, it's probably fair to say that most people focus on performance first. And that's equally applicable to the different functions of accounting, whether it be stewardship. When resources are delegated to managers, then there is the assumption that they're going to generate returns for shareholders and demonstrate their stewardship. And one way of demonstrating this is through the performance that the firm achieves. Maybe it's in financial contracting, such as the use of performance measures in management compensation contracts. Likewise, decision-making by investors may focus on performance as a starting point or a basis for commencing valuation, and this will dictate decisions to buy or sell shares. So it's fair to say that performance is something that most users of financial statements are concerned with. In terms of what performance measure we use, we need to understand there are a range of performance metrics that are presented. The one that we tend to give most emphasis to is the earnings number, or the profit or loss, the number that appears in the statement of profit or loss and other comprehensive income, which is dictated by IAS 1, and we've talked about that previously. A challenge with earnings numbers, though, is that this is presented on the basis of the whole firm, and investors often just buy parts of firms or shares. And so we also have the earnings number being restated on a per share basis, because that reflects how investors buy the shares, their interests. And the presentation or the calculation of earnings per share numbers is dictated in IAS 33. We also need to acknowledge that cash flow is also a measure of performance, and this is dictated by IAS 7. And we can't overlook cash flow at this point in time because at the end of the day we need to appreciate that profit equals cash flow plus accruals, and accruals represent the sum or the consequences of all accounting practices, of all accounting standards. So when we look at the cash flow and we compare it to profit, it gives us an appreciation of what impact the accounting processes have had in terms of transforming cash flow into profit. In terms of whether these numbers are useful or not, there's quite a significant empirical literature. Focusing on income first, we can look at Ball and Brown. And what Ball and Brown did was they were concerned with demonstrating whether accounting earnings were useful for users of financial statements, shareholders. So what they looked at was an association between changes in earnings and changes in share price. And their study was published in the Journal of Accounting Research in 1968. And what is reassuring for us is that they found a positive association between changes in earnings and changes in share price. The research has become a lot more refined in the more recent years, in subsequent years, and a paper was written by Easton and Harris, which appeared in the Journal of Accounting Research in 1991, and this demonstrated that it wasn't just the change in earnings, but the level of earnings which was relevant to stock prices. I suppose the point to make here is that in terms of the relevance of earnings, you want to have lots of earnings and you want them to be getting bigger. There was also a really interesting paper by Easton, Harris and Olson, which was published in the Journal of Accounting and Economics a year later in 1992. And what this looked at was the association between earnings and stock prices over 1 year, 2 years, 5 years and 10 years. And where this was really interesting is that whilst the association between earnings and stock prices might be minimal over short periods, 8% over 1 year, over a 10-year period was 60%. And I suppose the takeaway from that is that whilst we do try and manipulate cash flows through accruals to get a profit number which is more relevant, we still have significant issues with timing. It also suggests that at the end of the day, firms have to make a profit. Now, one of the arguments that we always have is, should we focus on earnings or cash flow? Cash flows is real, earnings is subject to manipulation. I suppose probably the one reassurance we can take from this paper here by De Chow is that she demonstrates is that accounting and the accounting processes are a value-adding process. What she did in her paper was she looked at the association between stock prices and alternative measures of firm performance: earnings, cash flow from operations, and net cash flow from operations. I'll just focus on the first two columns, earnings and cash flow from operations. What De Chow found was that irrespective of whether you had very short periods, quarterly, or longer periods, annual, there was a much stronger association between earnings and stock prices than cash flow and stock prices. So it sort of suggests that the accounting process is value adding. What she also found was that the association increases as you have a longer observation window. So whilst it's telling us that earnings do represent a value-adding process, we probably haven't got things as right as we could do, and that there are still issues with the timing in terms of when we recognise earnings. And this is probably something that you can see that we're working on with our accounting standards, but it's something that we can probably do better on at the end of the day. In terms of what earnings or profit represents, we can look at the conceptual framework. And in the conceptual framework, we can see that income is either an increase in assets or a decrease in liabilities. Expenses are a decrease in assets or an increase in liabilities. And the profit or loss is income minus expenses. No revelation there. When we look at the presentation of financial statements in IAS 1, we can see that income has two components to it. It has revenues and gains, and expenses comprise expenses and losses. So it's broadly consistent. And at the end of the day, earnings is the product of revenue and gains minus expenses and losses. In terms of how performance is reported, or the accounting standards which guide that performance, obviously we need to focus on standards which are concerned with revenue, and the most obvious standard here is IFRS 15, which is concerned with revenue recognition. When it comes to expenses, well, we're actually not going to see any specific standards today. The reason for this is that most of the expenses, the standards that are concerned with expenses, are actually addressed also in standards which address assets and liabilities, and so we're going to defer consideration of those standards until we talk about those asset and liability standards. We'll talk about earnings per share calculations, IAS 33, and we're going to talk about the parts of the statement of cash flows, IAS 7, which are relevant to help us better understand firm performance.